Hello, welcome to Dissident Canada. My name is Tyler. Today, I'm going to give you the dissident opinion very much on the path of the Canadian dollar, the loonie as it is. Um, Before I start, there's quite a few caveats to be made here. First thing is, I think there's a possibility that it could go like rocket higher. I don't know how high it could go, but it could realistically double from where it is um, relatively right now. What is it at right now? Like, and this is versus the U.S. dollar. So 71 cents to the U.S. dollar is what I'm roughly seeing right now. It could very much double that and go to 142 or higher. Okay. Uh, for that to happen, there are some caveats. You need to have a GFC style financial crisis, and what I specifically mean is wasn't so much a financial crisis as it was a monetary crisis, and it was globally synchronized, and that looks like we're heading in that path. Like it looks so much like we are heading in that path with you know, recently the breakdown in private credit in the United States, the way central banks are acting, the way banks are acting, the way bonds are acting, just a whole bunch of factors are pushing in that direction. And I don't see any, white swans on the horizon that could reverse it. Like the only white swan I can think of is that AI bubble pops, all right, and AI doesn't take a whole bunch of jobs. But seeing as AI really isn't taking jobs right now, it is the economy tanking and people trying to cost save with AI instead of, well, this is an actual technology that could supplant humans at this point in time, so we use it. Like, it's just not there. You can see that with the Taco Bell incident of ordering, was it Taco Bell? Maybe it was Wendy's, of ordering 18,000 cups of water from an AI uh, drive through assistant, and that completely destroying the system in the back end. Like, AI is just not there. Um, we're back into the companies are now remembering how to fire, the beverage curve, which is hirings versus firings. That's in the flat territory. It could reverse into more hirings, highly unlikely. Um, so like there's caveats that have to go in. That's one of them. Oil demand has to remain where it is or down. Um, that's and for that's only if Alberta were to stay in Canada. If Alberta were to leave Canada, and then oil could do whatever it wants because it wouldn't affect the Canadian dollar. So like there's a lot of caveats that I can't even think of them all before I say, hey, this is how it could rocket forward. But just pointed out there are caveats, and I cannot give you a timeline. That's the other thing, is because I can't predict what black swan is going to take down the market. There's too many of them. Um, but if I was my best guess, I would say if it's not this coming spring at the seasonal low point for liquidity, then we're probably going to repeat the timing of 2008, where in 2027 October it's going to start to break down. Like that would be my best guess. If it doesn't happen this spring, the start of a breakdown in the markets, specifically the markets, then it's going to be pushed off, probably to 2028. And it makes sense. Like a 20-year cycle for the euro dollar makes sense for the second cycle to begin. But anyways, my base case is that the Canadian dollar will do something very similar to what it did in 2008. Now, this is not a guarantee at all. This is just a theory of the dollar going to parity with the U.S. dollar. Maybe it'll do a dip back like it did in 2009 at the end of 2008 into the beginning of 2009, and then rocket back up. It could do that, or it could just rocket back up. Now, lots of reasons for this. The first one is that while people are out there screaming money printing, it's not really what's going on. And you can go to the Bank of Canada and look for the money aggregates. That's what they're called. Or you could look for formerly E1 data. And you can look at the very nice chart that is provided down below. It only has it's only got 4 months on it. And they are running 2 months behind on the most recent data. So it's not the most recent stuff, but if you look at currency outside the banks, that is the money, most of, if not all of, the money that's being printed, okay, by the Bank of Canada. Everything else is debt-based and works differently. Does it expand the money supply? Yes, but it also increases demand on a monthly basis, but it also skyrockets demand on like a longer term basis, because that's how debt works. But anyways, if you look at currency outside the banks, either unadjusted or seasonally adjusted, I prefer unadjusted because I don't know what adjustments they're making, and they are not transparent with that shit. Simple enough. But anyways, since April, we are only up, what is that, $3 billion. Not even $3 billion in that's a 5-month time period that it's looking at, so half a year. So that's roughly in line with a 4% growth target of the actual physical money supply, which is typically 2 to 4% from central bank to central bank. It's how they actually, the amount of money they print, to be real. So the physical money supply isn't expanding too much. If that were to change, then yes, the Canadian dollar would continue to drift towards zero against the United States dollar. The loonie would go down. I'm not arguing that. I'm arguing in a debt-based economy where money printing is relatively rare. I mean, it happens daily, but it's not, the thing that everybody claims it is. And again, look at the money eggs. You can see that very easily. So as long as that remains then the continuation of this video will hold true. The other thing is, I believe the carry trade, the loonie carry trade will blow up to a large extent once, again, everything starts to really kick off in the markets. The carry trade. What is a carry trade? It's very simple. It is foreigners coming into your domestic banking market and taking loans out, and then moving that money offshore and buying, a different asset. So the way that most likely works with the Canadian dollar carry trade is that it's most likely American banks coming over into Canada because the interest rate differential, especially right now, is 1.75%. So your cost of a loan is almost 2% cheaper. And like with the Canadian dollar having a general trade sideways and slightly down over the year, if you're an American bank who gets paid in American dollars, uh, it's easier. It's better for you to get a loan in Canadian dollars. All right, massive loan, say like 100 billion Canadian dollars, or uh, the equivalent in say 100 billion USD in the loonie. Then buy appreciating assets in the United States that are dollar denominated, and then you can quite easily service that debt because you're just going to be making money at that point. Especially this year, like if you say if you bought gold at the beginning of the year, I think you're up 10%. If you bought it last year, you're up like 50% or something like that, or 100%, I think, or to peak. Like that's a good profit if you ran the carry trade on that. But so as interest rate policy comes more in line with each other, as the Fed continues to cut, and they'll probably cut aggressively, and the Bank of Canada will probably be timid as all hell, like they have been with quarter point cuts. I don't think they'll aggressively go 50 or 75 basis point cuts. So the Fed will slowly come in to target. So that carry trade then is no longer super beneficial for Americans. There's probably also a really large carry trade with Europe with the loonie. So as that blows up, what that means is there is a large percentage of Canadian dollars that are just going to disappear, because that's how debt works. When you pay off the debt, you are destroying currency. You are destroying currency units that are in circulation. That is how debt-based monetary systems work out. But here's the interesting thing with this, all right, to keep in mind. As you are destroying dollars for loans, you are destroying currency, but demand stays relatively the same because of the ratios of currency, physical currency to debt. Now, does it slightly come back into a line? Yes, but when you're looking at like what is it? 121 billion physical dollars that cannot be destroyed, that have to circulate around and service almost $5 trillion in M2++ money aggregate, or M money supply. If you lose $1 trillion, you're still having to fly. That money has to fly around the system so fast. Like the velocity of it, that's what I'm talking about, is the velocity of money has to be like that. Now, I was having, Grok do some simple scraping of velocity for, is it M2? Yeah, just general M2 for Canadian dollars. All right? And since 68, velocity has only gone down. Not on a straight line down. Markets, do things, but it's basically straight down. From 1968, velocity is 2.68. All right? 2024, velocity is 1.15. Now, this is a relative number, and the calculation for this is relatively simple. It's basically just it's nominal GDP over money supply. I don't think that's detailed enough, all right, to give you an actual velocity number. Like, you have to take account for the money that does not circulate, that stays in banks. You have to take account for, um, I would say, demand and like daily money flying. But like that's too complicated for an equation for central bankers to understand. So it's just a very simple money calculation. Um, and I compared this to the velocity from the Federal Reserve Bank in the United States, the Fed, um, using Fred, which is the St. Louis Fed, which is a phenomenal data set that you can get into. I compared it to uh, USM1 velocity. I know it's a different money supply, and M2, and it's relatively in check. The M1 money supply in the US is basically currency outside the banks. Um, in Canada, it's a better look at your base money supply than just using M0 because a bunch of other shit is in there and this more tracks, consumers. If you look at it, like the and you understand that in debt-based monetary supply, in a debt-based monetary system, you need to have velocity accelerating as debt goes up. And you look at M1, just M1 velocity is terrifying, okay? In 2010 or 2008 is where it peaks, and it's at a relative number of 10.6. All right? Today, it's 1.6. That's terrifying when you look at the difference in debt that the entirety of America has, and how you have to service that. That's just crazy. So as long as velocity stays at that relatively, was that 50, almost 50-year curve of just downward trend, whether it be Canadian or American, it's going to be harder and harder to service the debt. So eventually you'll have more debt destruction, such as looking at the Canadian real estate, which is like, I was just looking at residential and commercial properties, all right? And it's roughly, $24 billion in size is the number I was able to find when you add both of those up. That's so you get another destruction of $25 billion in that 5 trillion. Doesn't sound like a whole lot of, but you realize that it's not, and that would be the entire market blowing up. Like that's not going to happen. It's going to be closer to say 10 to 20%, which is, 2.5 to say $5 billion. Look what 10% did in the United States with the housing market in 2008. It would be bad. So again, 10%, very bad. That does not account for the factors that crash those markets, which is jobs and income. That goes down, money stops circulating as well, and you have likely more debt coming out. I didn't even take the time to, calculate in, well, what would be 10% of just individual debt, whether that's credit card, auto, just personal loans that people have taken out over the last, again, 5 years. It's pretty bad. Like, when you start looking at all of that stuff, and you start looking at, debt destruction, whether that's the carry trade or domestic issues, velocity of money going down, there's a real chance that the Canadian dollar does do what I think it will do, which is a repeat of what happened in the GFC. I think that the swing could be more violent than what happened in the GFC, because as the euro dollar continues to go on, the swings that happened have become more and more violent, and the slowdown in the real economy has become more and more pronounced. So, while yes, on a longer trend, I think that the loonie goes to zero against the USD and goes, damn near infinite to gold. All right. I think when you have these massive euro dollar blowups, again, like what happened in the GFC, you're going to have a massive violent swing upwards because everybody's dumping their Canadian debt, dollar debt. Money's just not moving the way it has been. The velocity tanks, all right? And so, like, its relativistic value goes up. Now, there'll probably be a continued explosion in M2, which just, again, means velocity is going to tank. Uh, you can also see during COVID, like into what 2022 when we were at like 90 cents to the dollar, that was a partial unwind of the carry trade and a small minor euro dollar hiccup compared to what happened in the GFC, where again you had a now it was somewhat manufactured by what happened with COVID and the lockdowns and all that shenanigans. Absolutely. But I would argue the rollover was going to happen anyways because of what we saw in the credit market and U.S. bond market in 2018 into 2019. Okay, I would make that conclusion that it may not have been as big and prolonged, but I still think it would have happened. It could have actually been bigger, to be honest, right? Because with COVID, you actually saw an acceleration in velocity around the world, like money velocity. So that could have actually slowed down the violence. But anyways, so I would say again, if we get a GFC style blow up in the markets, very much globally, all indicators are kind of heading in that direction. I'm not saying we're guaranteed to get it. That's my personal belief. But hey, like, I haven't been doing this for 10, 20, or even 5 years of looking at this stuff from the euro dollar perspective. But that would be, again, my assumption. So I think, again, you could get a very good few years of the loonie at, like, say 130 to the USD. And then eventually, it'll draw down, and it'll probably draw down from, say that 130 down to 60 or 50 to the dollar. I think that will likely happen. It will take time to do that. Like, you'll see if you look at the loonie versus the dollar on a chart. All right, it most charts that I've seen only really go back to 2000, maybe even slightly before that. I think you'll have a repeat of that chart, but again, the peaks will be higher, the valleys will be lower. That is my assumption. And I think we are due for a massive violent correction because of debt destruction and, the carry trade blow up or potential carry trade blow up and velocity just tanking. Now, again, that all changes if oil demand goes up and if, as long as Alberta remains in Canada, and what else? Oil demand and velocity continues its downward cycle. If those two things or those few things are met, very much a violent swing upwards is possible. And again, it's just the mechanics of how debt-based monetary system works. I may be very bearish in the short term and very much so in the long term on the loonie, to the point where I think Canadians will start saving in US dollar stablecoins. I think it will eventually hit that point and very much be like Argentinians, Turks, Russians, saving in dollars to protect your purchasing power versus your own currency. Yeah. So that'll be the video today. Hope you had a good weekend. I'll see you tomorrow with, I don't know. But until then, have a good day.